Uncertain about cryptocurrencies? Is it a fraud? Since a lot of people are unfamiliar with cryptocurrencies, there is a lot of mystery around them, which has led to some people believing in misconceptions. This is due to the fact that people occasionally receive incomplete information. Avoid succumbing to the hype. We will discuss the facts and sort crypto reality from myths. Are you prepared to learn the truth about cryptocurrency and dispel common misconceptions about it? Watch today's video till the end to find out. Take a seat and let's get started. Since its initial introduction in 2009, the popularity of cryptocurrencies has grown significantly. Due to their ambiguous nature and difficulty in understanding, these digital currencies are the subject of numerous myths and rumors. Here are a few of the most prevalent fallacies surrounding cryptocurrencies, presented in no particular order, along with a fact check to assist you in determining if they are true or not. Digital currencies don't have value. Value is a relative term. An individual, group, or society may attach significance to an item that someone else discards. For instance, the initial cryptocurrency, Bitcoin, was only worth a few thousandths of a cent when it was originally introduced in 2009. As its popularity grew, the price of a Bitcoin hit $69,000 in 2021 and $77,000 in 2024 on the Polish cryptocurrency market. Its increase in value shows that determining an asset's value requires understanding how society views it. Technology breakthroughs in digital asset ownership, such as non-fungible tokens and decentralized finance applications, are based on Ethereum, the blockchain ecosystem that supports the cryptocurrency Ether, ETH. Although ETH may not be as valuable in dollars as Bitcoin, a company creating financial products and services that leverage the Ethereum blockchain and smart contracts can benefit greatly from its usability and potential. Cryptocurrencies are now being held by businesses and investors for usage in venture capital, finance, and other fields. For instance, as of the first quarter of 2024, financial services and investment firm Galaxy Digital Holdings managed more than $2.0 billion in cryptocurrency digital assets. Like many other assets or currencies, the dollar value of cryptocurrencies seems to change in response to supply, demand, investor and consumer sentiment, and economic conditions. Digital currencies are bad for the environment. Concerns regarding the environmental effects of digital currencies are warranted. Certain cryptocurrencies use a consensus technique to approve and verify transactions, which consumes a lot of energy and processing resources. Over time, one token, Bitcoin, has grown in value and popularity. As a result, big mining companies have sprung up to capture the cryptocurrency mining market. The energy needed to run the mining rigs on each of these mining farms is enormous, and when combined, the network's energy usage is comparable to that of several small nations. However, the energy source that the mining operations utilize and the effect that their energy use has on the power grid determine how much of an influence they have on the environment. For an intangible but valuable good whose future and benefits to society are uncertain, there will be extra carbon emissions if the mining activities get the majority of their electricity from fossil fuel-powered networks. Conversely, the environmental impact is reduced if mining operations are mostly fueled by renewable energy sources. Grids are strained by the high energy use in both scenarios. Not every cryptocurrency validates transactions using energy-intensive mining. Blockchain technology and cryptocurrencies are always changing, and some are making efforts to leave less of an environmental impact. To power their activities, Bitcoin miners have also bought closed fossil fuel plants. For nations striving to lower their carbon footprints and environmentalists, this presents further worries. Cryptocurrency is a currency of criminals and fraudsters. Many people are unaware of the revolutionary technology that lies at the heart of cryptocurrency. They can, therefore, think incorrectly that it is money that fraudsters and criminals are using. However, that is untrue. The goal of creating Bitcoin, the most secure digital money, was to create a decentralized digital currency independent of central banks and governments. Furthermore, money laundering, bribery, scams, Ponzi schemes, fraud, illicit funding, and corruption have long been a part of every culture. Not cryptocurrencies, but cash, which is untraceable, continues to be the most widely used means for purchasing illicit products and services. Crypto is not secure or safe. The purpose of Bitcoin is to enable safe and secure money transfers. Because cryptocurrency is generated on a blockchain network, every transaction can be examined and validated. When examined and validated, When people don't keep their cryptocurrencies in a trustworthy wallet or exchange, they run into issues. Therefore, before putting money in a cryptocurrency wallet, conduct some research. The blockchain is the primary technology underlying cryptocurrencies. A blockchain is a distributed database that is protected by highly impenetrable technology and encryption methods. Previous transaction data is encrypted and recorded in the new blocks as new transactions are added to the blockchain. Every new block in the chain builds upon the one before it, and a group of automated verifiers must concur that the data included in the transactions is accurate. This is where blockchains can become vulnerable. With a proof-of-work system like Bitcoin, the network needs to be sufficiently big and quick to stop someone from introducing a modified version. While smaller blockchains have been taken over, Bitcoin has not yet faced difficulties as a result of this. Validators on Ethereum, a proof-of-stake platform, are required to pledge precious money as security for truthful labor, or else they run the risk of losing it. This is incredibly costly since, at the pricing as of July 5, 2024, 32 Ether, or around $95,000, are needed to become a node that can propose blocks. Blockchains that do not employ costly collateral may be vulnerable to hacking. There are various consensus methods in use, but how secure they are relies on how the network is set up and how broadly they are used. The access and storage of cryptocurrencies, such as in wallets or centralized exchanges that support trades, present another security risk. While sending Bitcoin from one user to another is completely risk-free, the systems and tools that are used to store and access it are susceptible to hacking and manipulation. To secure your cryptocurrency, there are a few secure techniques you can employ. For example, you can store the keys to your cryptocurrency assets outside of exchanges and in cold storage. When you're ready to utilize it, use a secure wired connection to transfer only the desired amount to your hot wallet on a non-mobile device, such as a personal computer. Cryptocurrency is not taxed. Neither banks nor a central authority are involved. However, this does not mean that the virtual money will not face taxes. You get taxed on it like any other transaction, whether you sell it or receive payment in cryptocurrencies. If you trade cryptocurrency in India and make a profit greater than 10 lakh rupees, you are required to pay 30% of that profit. This is for gains that occur quickly and don't need holding the investment for a set amount of time. Hacking of cryptocurrencies is simple. Utilizing a cryptocurrency trading platform is similar to using any other trading platform. The only method to safeguard your wallet and allow safe transactions is to increase the security of wallets that offer Bitcoin trading. Cryptocurrency is anonymous and untrackable. Because the person who created Bitcoin, Satoshi Nakamoto, is anonymous, many people believe that cryptocurrencies are anonymous and untraceable. Nevertheless, that is untrue. The idea of Bitcoin, that it is a decentralized, censorship-resistant currency, was preserved in part by Nakamoto's obscurity. Since cryptocurrencies run on a public blockchain, anyone may look at their transaction history. Although personally identifying information cannot be revealed when sending or receiving cryptocurrency, crypto addresses are permanently stored on the blockchain. Crypto addresses can frequently be connected to cryptocurrency exchanges where users transact, and personally identifiable information can be identified using KYC, Know Your Customer processes. Cryptocurrency is unregulated. Even if there isn't a strong legal framework in place for cryptocurrencies yet, there are nonetheless authorities in place to monitor them. In the United States, Bitcoin has been governed by the Bank Secrecy Act since 2013. Information about cryptocurrency-related financial transactions is gathered and examined by the Treasury Department's Financial Crimes Enforcement Network, FinCEN. In a similar vein, cryptocurrency profits and gains are subject to taxation in the United States, contingent upon the manner and duration of ownership. Cryptocurrency is treated by the IRS as a digital asset, just like stocks, bonds, and other capital assets. There are also tax rules in China, India, the UK, and Europe. Crypto will replace the US dollar. The idea that Bitcoin is a danger to the US currency since it was developed following the 2008 financial crisis is a prevalent one. First off, while the creation of Bitcoin coincided with the 2008 financial crisis, there is no connection between the two. Second, Bitcoin is limited to being a decentralized virtual currency. The US dollar and other fiat currencies took a long time to create, and changing them is a difficult task since governments base policy decisions on the information provided by these currencies, which banks use to monitor the state of the economy. Numerous stores now accept Bitcoin and other cryptocurrencies as forms of payment. It is recognized as a legal currency in nations like El Salvador. It does not, however, imply that cryptocurrency will eventually take the place of the US dollar. It's challenging to imagine how the economy would function, how to control inflation, and how laws would be created if cryptocurrencies were to take the place of fiat money. There is only one huge blockchain in place. There isn't one bit. Numerous blockchains exist. Blockchain is merely a technology that addresses several issues. For example, it might have public or private versions, an open or closed source, etc. While some blockchains support Bitcoin, others may support other cryptocurrencies such as Ethereum, Ripple, and so on. Because Bitcoin is such a novel and abstract concept, there are numerous myths around it. Many of these fallacies will eventually be disproved or confirmed as more people get to know cryptocurrencies and how the ideas underlying them may improve society. Remember that knowledge is power, and knowing the fundamentals of cryptocurrencies will enable you to make wise investment decisions. Never stop learning, being informed, and being interested. How has your attitude changed now that you know the reality about cryptocurrencies? What are your expectations about cryptocurrency in the future? Let's discuss this in the comments. Kindly use the like, share, and subscribe buttons if you want to see more videos on this channel. Until next time, bye.